So for those who will be joining us for the first time, I'll give you a quick overview of who we are. So we are the Institute of Economic Affairs, a public policy think tank that is based in Nairobi, Kenya. And what we do is we conduct research, and out of that research, use it then to have policy conversations and dialogues on different issues. And because we do it on different issues, we are an institution that is run across different programs. So we have the competition law and the constitution law and economics program. We have the popular economics program. We have the economic regulations program. We have the public finance management program. We have the futures and foresights program. And of course, we have yours truly, the conveners of today's meeting, the international trade program. So that's a very quick overview of who we are. So without taking too much of your time, I know we are having a conversation this morning, like I have earlier mentioned, on the shape of Kenya's international trade and its policy implications. And why do we think that this conversation is important? We think that the conversation this morning is important because we are aware that Kenya's international trade is a very critical driver to our economic growth. And this is shaped by the fact that we conduct exports, we do imports, and we have regional partnerships and global different global trade agreements. So because of that, Kenya has been in a position to place itself as a physical gateway to the East African region, owed to the fact that we have very strong linkages through our ports to the global markets. So because of that, we have seen people run to us as a trade hub. People want to set up in Kenya. And then, of course, why is this important and what really drives Kenya's trade environment? So Kenya's trade environment is largely driven by our exports in agriculture. We have manufactured products, we have services that we export, and also we have a significant import in machinery, fuel, and technology. So when you look at all this and the happenings in the global trade environment, you realize that there is a lot of global market shifts that are currently ongoing. And so because of these global shifts that are both expected and come with different global complexities, we have seen our trade agreements with different countries and even with both global, regional, and local agreements evolve. So when this evolution happens, of course, there is a need for our economic trade policies to adapt to these changes and the changing conditions. So because of that, we need to be in a position as a country where we are able to critically examine and understand our structure, our trade structure, the country's trade structure, and also as we understand that as we understand that trade structure, we also put ourselves in a position where we look at the implication of that. What is the policy implications that would attract to this country? Are they implications that will bring opportunities? Are they implications that bring risks? And how then do we prepare for that? So that is why this morning my colleagues Emmanuel and Moses will be speaking to us about the status of Kenya's international trade and what that means for our trade policies. And as they will be speaking to us about that, they will be touching on the opportunities and the risk that these present to Kenyan households, our farms, and of course, the big people who are our government policy makers and the policies that they are thinking of or the policies that are already being implemented when it comes to our trade sector. So without going too much into it, I would like to invite my colleagues Moses and Emmanuel to make their presentation, after which we will have an opportunity to have a Q&A today, where you, our listeners, will have an opportunity to ask your questions, if any, and give your comments as far as our conversation this morning is concerned. So Emmanuel and Moses, please take this away. You have just about 15 minutes to make your presentation, and then we can move to the next segment. Karibuni sana.
Thank you so much, Winnie. Now, why is this subject important? We can pick all kinds of reasons why it's important for us to examine the state of Kenya's trade. I present two. Kenya, we're living in a Kenya whose economy is stagnating, whose poverty rates are growing to such an extent that we are almost just as poor as a country as we were around 2002. We're also living in a world where trade is challenged by flagging faith in multilateralism. So I'll allow my colleague Moses to take it away and talk about and begin laying out the profile of Kenya's trade.
So, as Emmanuel pointed out, what we try to do here is to paint how does international trade look as of today, and then ask ourselves what does that mean to the economy, and in case we are to align within the policy landscape, how are we supposed to do that? So, what we are going to look here at is what the data is saying in terms of how open are we to international trade, what is the basket of commodities that we are trading in, what does that imply to our economy, and in consideration of our ambition as a country, what need or what does that direct us into, or say we are doing right, or what are we missing? So in terms of trade openness, this illustrates how outward or inward oriented we are as a country in terms of allowing ourselves to sell to the outside market and also buying from other countries into our country. Let's proceed to the next. So how we determine how open we are to international trade, we look at what percentage of trade what is the percentage of trade compared to our GDP. So this one we take the total value of what we import and what we export. We sum them up. That makes the basket of international trade. And then what that we compare the percentage of that to the GDP. So what that tells us is how much of our GDP is on international trade. So as we can all see, the light blue line represents Kenya. In the 1970s, trade contributed to a higher percentage of GDP than it has been lately. So this means that generally Kenya has been, in comparison to the GDP, has been reducing in terms of our international trade. So we ask ourselves within our peer group, and by peers here we mean those that in the 1990s had almost a similar GDP per capita with ourselves, how do we compare? And we can clearly see that whereas our peers have been increasingly opening up to international trade, Kenya is doing the reverse. As most of us know, Kenya GDP per capita in nominal terms is about $2,000 per year. And therefore that places us in the lower middle income countries. And you can also see that Kenya is also low in terms of trade openness. Kenya is lower than the middle income countries batch. And then we ask ourselves, which other economy that Kenya can point out to in terms of being open and small? And by open means that it's allowing trade in the global market with itself, and small meaning that it doesn't have excessive or substantial economic power to influence the international global market prices and income. So when you look at Netherlands, as of 2023, they're about 200 their trade is about 200% of their GDP, meaning that they are allowing a lot of imports and export to happen within within the country. And therefore, if Kenya is to replicate that, then we have a huge differential if you compare to that. So what does this mean? Why is it important that we know about the trade openness in the country? Number one, our trade openness speaks into our policy. What trade barriers have we put in place? How is our infrastructure helping in terms of trade? How efficient is our technology and the scale of our economies allowing us to produce for the international market? And it also helps us to realize how competitive are we within the global landscape. And that is necessarily important because one, the countries that are more open to trade accelerate the productivity. As we can clearly see, Netherlands being an open and small economy, their GDP per capita is doing way much better than we are doing as a country. And then trade as trade allows, and Emmanuel is going to point towards this, allows a country or an economy to focus on what they can actually do best and allow themselves to buy what other people can produce in a more efficient manner, so lower costs. But in case that is limited, then it means our efficiency in production is actually limited. So when that is limited, and uh, research has shown that countries that are more open, they have permanent and economically sizable impact in terms of growth. So trade also allows structural changes because it allows an economy to move toward what more efficient ways of doing things. So the fact that Kenya is actually deteriorating is a concern. And it's also a concern in the policy landscape because clearly we have had policymaker allude to the fact that we need to be more protective of our industry, therefore creating more barriers to trade. And as we can always see, we are deteriorating, therefore that would even make it worse. So away from trade openness, we ask ourselves, what is the overall Kenya's international trade? So this is in real terms. So as we can see, relatively, we have been increasing our imports, and at some point they are reducing. But it's good to note that around 2020, so when we from 2020 to 2021, the shift was bigger. And one of the reasons this is because of policy orientation. And remember that for us to trade in the international market, also our exchange rate, foreign exchange rate also matters in this case. So they have been concerned about the strength of the shilling, and therefore, the more it strengthens, the more exporting becomes difficult because it makes buying from us more expensive, but it also makes it easier for us to actually buy from abroad. And therefore, that could explain partially why there was a significant shift in 2021. But what we can see here is that in the last 10 years, Kenya has been having a trade deficit. What this means is that we import more than we export. Necessarily, this is not a bad thing. So a trade deficit or a trade surplus are not by just virtue of themselves a good or bad thing, but it implies to how the economy is performing by itself. So if you check into, for example, the exports, a leading contributor of our export, next slide, please. A leading into our export are more agricultural-based products. So what this tells us is that one of the things we need to note is that each good has a different complexity in the market. And by complexity here, we mean how much technology and skills and goes into its production. So more complex good fetch more returns in the market compared to less complex good. In our basket of export, which is dominated by tea, cut flour, clearly we can see it's more agriculture oriented. That means that we are trading on a less complex level, which is a disadvantage to some extent because it means, one, the global prices of these are not as high as of the manufactured goods. And number two, it means that competition on this angle is higher. So substitution is clearly higher. But notably, we can realize that among the major export destination here, we have the USA, we have Netherlands, we have the UK, but on a general sense, Uganda is the main destination of our exports, followed by the United Arab Emirates as of the last quarter of last year, and then the United States. So this is important to note because the political landscape, the economic landscape in our export destination also affect us. So if the US, for example, were to add tariffs to Kenyan export and then being among the top 3 destinations, that means that our trade on this end will be restrained. On the other hand, if there's political tension between us and Uganda, that also means that our trade is going to be restrained. Notably, 10% of our total export actually consumed by Uganda. So Uganda is a key major export destination for Kenya. And then we look on the other hand, where do we get most of our leading exports, imports into the country? So next slide. So here, first of all, what items do we import the most? So we have refined petroleum, we have palm oil, wheat, medicaments, and then we have iron. So these are the major items in our import basket. And this, for petroleum, we mostly get it from UAE. For palm oil, we get it mostly from Malaysia. For wheat, we get it from Russia. Medicines, we get them from India. And then iron, we get it from Japan. So these are the major countries that feed into our demand from the outside world. And what this shows is that if you check this, some of the items we are still demanding are agricultural in nature. And therefore, there have been always a conversation of, can we be able to make Kenya self-sufficient in the agriculture basket? Can Kenya produce fully its own food? By checking at this import and the fact that we get palm oil and wheat from the outside world, it clearly shows that we are not self-sufficient in our production. And that's not necessarily a bad thing, because if a different country can produce some agricultural products more efficiently than us, then it's clearly more, it's also important that we actually buy from them and then focus on producing what we can. The twist here becomes when policymakers make it a question of, is producing our own food meaning we are more powerful than if we buy them from the outside world? And the reason why that discussion needs to be elevated to what can we do better and what we can, it's because if we focus on self-sufficiency of producing our own food, what we do, we place the country at a risk of using more resources in production of an item rather than focusing on producing what we can produce with less cost, and then buy what we can actually buy at a lesser cost than we can produce within the country. Next slide, please. So here the export and imports are separated, but one key thing here on the export part is the re-export bit of it. So what we export necessarily is not produced within the country. So sometimes we buy from abroad just to sell. For example, Kenya exports machinery, but most of this machinery are not actually produced within the country. So we, for example, buy machinery from Japan, bring it into the country, and then sell it to a neighbor. As we probably know that Kenya is among the gates of the Eastern African region, and therefore that gives us an advantage of supplying to our neighbors. And notably, we need to note that Kenya imports a lot from Africa than it exports to Africa, and the same apply to the world. We we export less than we import in comparison to the world. But for East Africa, we actually export more to East Africa than we import from them. And therefore, Kenya being a gateway into East Africa gives us an advantage. But as we can clearly see, within the last 10 years, our re-export are still too low. And therefore, probably we need to ask ourselves, what efficiency question is derailing us re-exporting more? And like I said, if we compare ourselves to the open and small economy of Netherlands, which is a leading importer and exporter in the world, we could ask ourselves, what is straining us from exporting more to our neighbors, even if we are going to export what we have imported from other countries? Uh, the leading imports in Kenya are more from commercial imports, and then government imports a bit to make sure they're able to run uh, public goods within the country. The next thing we asked ourselves is to compare the quantities and the prices of our imports and export, asking ourselves, what is the elasticity of demand and how have the prices been changing? So in this one, I won't focus on every item, although this one will be available for our scrutiny after this. But notably, in our import basket, non-oil imports prices have been rising. Over the last 10 years, the prices have been going up. So meaning the global prices landscape has been changing with about 12.7% of non-oil imports into Kenya. What this means is that the global prices have been jumping, and what we also do is ask ourselves, what is the elasticity of demand in this case? But even so, we realize that beverages and tobacco prices have been going higher, those that we import. And one of the reasons this is we have been using a lot of, let me call them sin tax against beverages and tobacco. And the fact that the prices have been rising higher than the overall non-oil imports could indicate to our policy landscape to that. So what that means for the economy and also for household expenditure can be felt by people substituting or people directing more resources to that. Again, as we can see that machinery inflation has been higher, 6.36. It's good to note that because, like I said, we not necessarily import machine and transport equipment for sale. We also import them to sell them to our neighbors. And this inflation will be necessary to check against what will be the elasticity of demand for this item. When you go to the export side of the story, we realize that averagely exports prices have risen compared to all exports. But if you look at non-oil export, the inflation has been lower if we compare with the non-oil import. So what this means is that although the prices for what we import has been rising, equivalently the export have been rising, and in this case at a higher degree. And if you check the export of machinery and transport equipment, you realize that for us to export, the prices have not been rising as higher or faster compared to what we import. So what this implies that the machines and transport equipment we are importing into the country are not are gaining prices, so we are paying more for them, or the prices are rising at a higher rate as compared to those that we export from within our country. That could be an indication of a strain in that particular item. And if you look at the agricultural material and items in this list, you realize that also the imports of the same uh, are higher than the export of the same, which is a good consideration because it actually tells us uh, where do we have an advantage or where we lack this advantage. Uh, on the now last bit where we compare the elasticity, we'll just focus on three items in the imports part and then the three items in the export part. So there have been a discussion of, like I indicated earlier, the question of can we fully rely on ourselves to actually produce our own food is being challenged in this case. And as we can clearly see, the elasticity of demand for food and live animals, if you compare for animal and vegetable, you realize it's elastic. And therefore, if the prices of these imports go high, Kenyan households will opt to reduce their demand at a higher level than the unit price increase. What this means is that these imports are necessarily not luxurious goods. So they are not being imported. We are not importing food, animal, vegetable oils as a luxury. It's a necessary household item. But if the prices go high, people will either go for the local substitute, and that has an implication of the market prices for local commodities, because that means if the prices of food and live animals go high, Kenyans reduce their demand for imports of the same. Once that happens, of course, the demand shifts to what is being produced locally. And if that happens, of course, due to the forces of demand and supply, what we have is the prices of local commodities going high. And once that happens, it strains a part of the population. And like Emmanuel indicated at the very beginning, 40% of the population in Kenya as of 2022 are below the poverty line. If you compare also the machinery import, if you round off these to 0 decimal point, you realize that it's also elastic, and meaning that if machinery and transport equipment go up, people will opt not to import them. One, because it makes it hard to resell them or re-export them within our neighborhood. And number two, it also shows that it increases the productivity cost of producing locally. Some of the comments that will be given today, and Majuna is here, who has been working on structural changes that happen with our export and imports. You realize that if the machinery and transport equipment keep going higher, the structural change we desire as a country to actually change into a manufacturing hub is being strained with time and time. And we also ask ourselves, what is the policy consideration of that? Lastly, on the export bit of it, the items of concern here are mostly also vegetable oils and machinery. But notably, machinery elasticity of demand, it's more elastic in the export side than it is on the import side. And what this means is that a shift or an increase in prices of machinery and transport equipment in Kenya means that it makes it undesirable for us to export. It reduces our market competitiveness to re-export these into our neighborhood. And this similarly applies to animals and vegetable oil, chemicals, and closely to beverages and tobacco. So with all this, with the alternating nature of the basket of commodities here, we need to ask ourselves, does the basket of export and imports reflect what we want the structural changes to happen in our nation? Number two, we also need to ask ourselves, what does this mean around the policy we formulate for the country? And something to note is that Kenya is Kenya's agriculture production is quite high comparatively to other sectors of production within the country. And Kenya has a lot of cheap labor comparatively also to other countries. But the global market, even though the global market in terms of trade has been increasing averagely at 6% over the last 20 years, is yet to fully liberalize labor-intensive industry and agriculture production. And therefore that leaves us at an disadvantage, because also what we could probably have more comparative advantage in is also being restricted in the global market. At this point, I'll invite Emmanuel to give the policy side of it. Thank you.
What to make of all this, of all these data points? Well, when we zoom out again, after having had a look at the price sensitivity of Kenyan consumers across different products, and we're trying to ask ourselves why, what has been going on in the Kenyan economy, and what does the picture of trade say about this? Well, when we go and look at the current account balance, which is tries to tally the balance of the trade in goods and services, we can see that we have persistent deficits. When you compare these persistent deficits with the intensity of knowledge involved in what we produce, we can see that the intensity of knowledge involved in our production has been falling, right? There seem to be signs that Kenya is going through a premature deindustrialization, which is another way to say that the engine of growth, right? The activities that have been flagged by economists time and time again as the sort of activities that actually make nations wealthy are not only are they not growing in their magnitude in Kenya, but they're actually shrinking. And there's other signs like growing, like diminishing imports in machines, which is a signal that producers, manufacturers sense that they're not as competitive as the country, the macroeconomic environment makes it so that they can't be as competitive as their neighbors, right? So here we see that, between 2019 and 2023, the overall balance between imports and exports deteriorated by -4%. Then if you look at the chart overall, we're just persistently in the negative. Then, so the engine of growth, right? That's the question that we keep asking ourselves. If Kenyans are, if 40% of Kenyans now cannot afford certain basic needs, and that number actually are living below the poverty line, the question is, how would they be lifted up, and what relationship does trade have with their welfare? Well, the thing is, you're living in a country and you engage in some activities and you try to sell goods and services to those living within your country. Well, if you could reach markets abroad, then you've expanded the potential customer base, right, of people that you can sell to. And so what you're looking for as both an entrepreneur and a worker is, okay, can I work in a company that has access to global markets? Because maybe, all things considered, that company, if it is competitive, that company will be selling goods and services to a wider market. And maybe that also means that I will have higher incomes. Well, that maybe is turn into a high level of certainty when it is considered that the level of knowledge intensity involved in an economic activity has a high correlation with the level of the per capita income and many other measures of economic welfare, right? So in sum, a country that's producing Lexuses, is likely to be much wealthier on average than a country that's producing tea. Now, in Kenya's case, Kenyan exports for tea, which were valued in 2023 at around $1.37 billion, gave it what is called in economics a revealed comparative advantage of 497. This number is arrived at by taking the value of products exported, and you compare this to the overall export basket, and then compare it again against the size of the global market for that specific product. In this case, Kenya was exporting, Kenya's top export was tea. That export is valued at $1.37 billion, and the global market was valued in 2023 at $7.24 billion, right? So which is saying that Kenya was servicing a $7 billion market with and taking a market share of about 1.37 billion, which is very big. And when you compare this to the size of Kenya's economy, this data says Kenya should only be exporting $2.4 million in tea. What are you doing exporting 1.37? That is a lot. It's a big number. But now herein lies the problem. What we're trading in is just tea, right? There's only so much land. They're not making any more land. There's only so much you can do to further process tea. There's a cap on the amount of knowledge involved, right? So the next question would be, where are the opportunities? So one opportunity, now this example is given as to kind of raise our alarm in terms of where are the low-hanging fruits. Now, crustaceans have what is called a relatedness of 0.32. Now, this number is simply telling us that when you take all of Kenya's exports and you compare them with each other and you ask, okay, how related are these activities to other activities, like to each other, right? So, for example, the expertise related to farming or fishing crustaceans, that's also fishing. So any other kind of fishing activity is related. So you take all that and you compare also with the level of complexity. There is an opportunity in investing in crustaceans. Now, there's the problems that the fishing industry actually faces, right? Illegal, unreported, unregulated fishing and pollution. All these are serving to depress Kenya's freshwater fish supply. Sorry, not freshwater supply, but the supply of Kenya's freshwater fish. In this industry needs investments in law enforcement and infrastructure like cold chain. When industry experts talk about the cold chain infrastructure, what they mean is I should be able to get a fish out of the water, put it in a freezer, and then move it to a truck that has a freezer, and then move it to a distribution center that also has a freezer, and then from there it means that these fish can remain fresh. Now, if this infrastructure isn't there, then I, as a fisherman, can only take my fish so far. I can only access markets so far afield, and then I can only export so many fish. So this is just to show that, yes, we can't build Lexuses as of yet, but there are low-hanging fruits that we're leaving unexploited and unpicked. And now finally, to close it all off, what we have before us is called the diversification frontier. Now, how do we make sense of this chart? Well, what what a policymaker would be asking themselves and looking at this chart is they're looking for the low-hanging fruit, and they're looking for the potential areas where if you could just if you could just drive investments in that direction, then they would generate so you're talking about investment in factor inputs in a sector or a subsector. What kind of returns would investments in that subsector actually engender, right? So on this chart, products that are on the top, on the y-axis, you have product complexity. On the x-axis, you have relatedness. Now, what you would want is to have opportunities that have a high level of product complexity, so right at as close to the top as possible, and products that have a high level of relatedness, that's as close to the right as possible. So a product, but in Kenya's case, this diversification frontier shows that there are no products or sectors that sitting on the top right of the chart, which is to say that there's no there's no group of product with a high level of relatedness to what we are already doing, and a high level of complexity such that if we invested there, Kenya, those working in that subsector would see their incomes actually improve dramatically. But what we have instead, right, we have products here on the bottom right. Now, these are products, they have a high level of relatedness, but a low level of complexity, which means we're doing a lot of things that are just easy to do, right? They don't involve a lot of knowledge. This is from the perspective of our exports, right? It's just a menu of our exports. We're doing a lot of things that don't require that much knowledge, but that are related. So, for example, that brown dot is it's extraction of some raw minerals. So these is probably something like some metals of some kind being extracted out of the ground. So it's telling us, yeah, there's still opportunities that we could probably invest in mining something, but mining and exporting mined products doesn't generate that much wealth. It's not that complex. It's not that much value added to it. And then on the other side, we have on the top left corner. Now, these are opportunities with a high level of complexity, but very low relatedness, which means, hey, this is an opportunity that you could try it out, but it's going to be very, very difficult. So from a private sector perspective, it's probably it's a sector where you might not find as many experts that you can employ. You might not find as many tools on the market that you can purchase. So it means that the factors that you need, the factors of production, are just not available in sufficient quality to render it a cheap area to invest in. And from a policy perspective, you might spend now, depending on what the specific area is, you might expend resources in an area that is just doesn't provide the necessary justifiable returns. So this is a poor picture, and it's a picture that's typical of a poor country. The low-hanging fruits that do exist, it's more investments in chemicals and textile subsectors. These are the low-hanging fruits. So you're talking about, you've seen all those pharmaceuticals that Kenya already produces. Well, the question is, can Kenya produce more of those? Finally, Kenya did export $199 million of machines, but given Kenya's position as a regional trading hub, just because of its access to ports, it's likely that Kenya was importing machines and then exporting them again to countries in the region. And so with that, invite our guest, Professor Socrates, also to give his points, and I invite Winnie to help us close this part of the presentation.
Thank you so much, Manny, for your presentation, and thank you so much, Moses, also for your presentation and just giving us the highlights of what we should be actually expecting as within the trade environment, with the trade changes that we anticipate to happen, and how moving forward, what uncertainties we might be experiencing with the global changes, with the treaty changes, and of course, like you said, with the evolving changes. So Moses and Emmanuel have taken us through the status of what Kenya actually looks like, trade environment looks like. And it would be at this point now that we would also want to hear from you, our listeners, your views and your take homes as far as today's conversation is concerned. And as we move to the Q&A question, feel free to also not just ask questions, but also to give us your views on, as far as our trade environment is concerned, do you think as a country we are doing enough to use the opportunities those present to accelerate our economic growth and development, or is there a way we are still slagging, and what you think that actually can be improved? And to Emmanuel and Moses, as somebody who is slowly getting to understand the trade environment, it's important. It will also be important for you as we speak to the status of Kenya's trade policies and what our international trade outlook really is. Would it be possible for you to link that outlook as currently is to the political happenings currently? Are those it's our trade outlook something that we need to think about when we are talking politics? Like, are there political opportunities that we have missed on, and probably directly speaking to the AUC conversation that has been going on, that our trade outlook had actually a role to play on that? And moving forward, what are some of the things that, as people who are in that space, you would actually advise that we as a country now look back to and start having more in-depth conversations? Should we be broadening our trade reach to more globally, more regionally, or is there more work to be done locally that then would allow us to spread our wings to the global and regional areas and environments? So for me, that's something I would want you to speak to. And then, so to our listeners, this is the point where, given the insights you've gained, do you have any questions? And if you do, you would use the raise your hand icon at the top of your machine, and we will allow you to voice your question. And if not, you could then use the chat box to type in your questions or your comments to Emmanuel and Moses. So at this point, I'll give you maybe a minute or two to type in your questions. And if there's somebody who wants to voice it, this is the time for you to do so. So I see Majun Socrates having something to say as we proceed to the next sessions of the Q&A. So Majun, please unmute yourself, introduce yourself proper, and then you can proceed to give your comments or ask your questions.
Can you confirm that you can see my screen?
Yes.
Okay, many thanks. So first of all, I would like to congratulate Moses and Emmanuel for this presentation, and more so for the invitation to this session. I have a lot of respect for your CEO, Kwame Owino, and I'm quite happy for this invitation. So here I'll briefly just give some commentary on what they have already presented, and possibly to just improve on some of the things that we can introduce in terms of the policy. So setting the stage, in a nutshell, what I understood what you're trying to do is to assess Kenya's international trade and give some policy implications. By this, you've described Kenya's trade landscape, who are the main partners, the products, both exports and imports. You've also described the unit value and also given some policy implications in terms of structural change and also where actually to invest. So on my end is something that I'm a big advocate of. I know a lot of the statistics that you've shared are purely at macro level, but then the reality is that it is farms which actually trade. So I've always looked for an opportunity where we attend sessions where we also talk about exactly these are now the exact farms that are trading. What do we see from farms instead of what we are just seeing again at the macro level, what you've done very excellently. So here I'll briefly just take us through some of the things we see from the farm perspective, more to complement what you've already done. What are the numbers? Which are the farms that are engaged in global value chains? Because those are the farms we really want to see how they can boost Kenya's trade. And then how is actually the performance of trade? Export potential to complement the aspect that you've already done on complexity analysis, very nice. And then a lot of what I didn't hear is around trading services, which is something that I think is crucial. So quickly, this is just a graph. What we see, this table here shows the number of exporters and importers in Kenya. You can see on average from 2008, maybe around 4,900 exporters, same time importers are almost 5 times. And that is almost the same thing as of 2020, they're about just around 8,000 exporters, and the importers were way much more, almost 46,000. If you look at how much these farms in Kenya, so this already tells you that the number of importers exists that of exporters, and of course it talks to what you found as the imbalance in the trade, or rather the net, Kenya being a net importer. Looking again, how many products are exported per farm in a specific market, in a specific month. This will be crucial because if you also want to target farms, how do you want to encourage them? Are they diversifying markets? Are they diversifying their specific commodities? This is just an insight. So we see that for exports, just about 10 products are exported on a monthly basis for most farms in Kenya. And then the importers are 7 commodities. This at harmonized system digit 6. How many partners does a farm have for exporters? Where we actually export is roughly 3 countries. For imports, we are actually importing from roughly around 2 countries. And then this shows the average value per farm in a specific month. Let's now look at the farms that engage in global value chain, what we are calling here as two-way. So farms which only import, those which only export, and those which do both export and import, which are mainly described in literature as global value chain farms. So we see, of course, there are fewer. And what was worrying me, possibly you could also try and speak about, is this decrease in the percentage that we are seeing from 2017. What could this be telling us? Why is it that we are having farms that are known to really boost a lot of trade, these global value chains? If you look at how much share they have in terms of trade, is usually over 80%. But then why is it that their number is decreasing? That's something that we can think of. This other graph just shows us some of the aspects that I am happy you've been talking about. For instance, we see large farms account for around 45% of Kenya's export value in a specific year. Same thing. For imports, we have large farms accounting almost 60%. So then we have the aspect of medium-sized farms, especially for exports. Maybe something that you might also try and think of, how do we encourage these farms? You can see they are accounting for almost 43% of the export value. You've been describing about whether a commodity is final, whether I don't know, some of the agricultural commodities, are they good or bad? How much intensity does it go in? Of course, in literature is what sometimes people describe as, is it a final good, intermediate, or is it a homogeneous or differentiated commodity? Also in terms of where we export and import from, we see that Kenya mostly exports to Africa, almost 42%, and mostly Asia. And here comes with the aspect of structural change. A lot of these Asian imports here come from China. So as I almost conclude, because I see my allocated time is almost over. So this graph here, this table here just shows the difference in terms of the export growth and also import growth from 2006 at a monthly level, January 2006 to December 2022. On average, we see that the growth has been above 5.8% for exports and then 7% for imports. But then what you should take in note of, since I'll share these slides with you, is this aspect where we are seeing, so the intensive margin tells us, is this growth being pushed by farms which are already existing or relations with the countries where we are already exporting to, or products which a farm is already exporting or importing? Or is this growth being driven by new partnerships in terms of new farms coming in, new partner countries or new products? As you see, out of this total, we see that extensive margin actually is having a bigger share in terms of the impact on growth. So that tells you, how can policy also push to see how do we target these farms that are joining, especially farms that are joining this, either starting to import to Kenya or the new farms that are exporting out of Kenya? How do we encourage these farms, and how does policy address that? Of course, we see most of these farms are large. Large farms have a huge effect on what growth we are finding, and then also exporting of final commodities and still importing what we call intermediate. Of course, I put references here for just more explanation. So one of the things you can improve on your explanation of product complexity is also to refer to the International Trade Center's export potential map. So for instance, on this graph, we are seeing top 20 commodities which possess highest potential. Of course, you've done the complexity, but then here, and it's something that I encourage anyone, it's you just need to go to the website, you click some things there, you can see black tea has the highest potential in Kenya. It can show you exactly how much is it in terms of dollar value. And it can also show you what markets exactly for a specific commodity or generally. So I think this export potential map, assessing it, is also something that can improve your assessment of Kenya's trade landscape. Lastly is also the aspect of services. Maybe you'll tell us why you didn't talk so much about this, but you can see from this graph is that the share of services has kept growing over time. These services in terms of our total exports in Kenya, I think the current value is almost 50% for both goods and services. So possibly, how does Kenya also approach a policy to promote the export of services, to just see whether we can reduce the trade imbalance that we are seeing? Those are my comments, and once again, congratulations and thank you for the invitation.
Very clear that beyond just adding insights, you've asked a few questions. So I hope Emmanuel and Moses were able to note them as you were speaking to them. And probably just to alert you, when they will be responding to your questions, I've seen you've asked questions about the services. So at that point, probably we'll ask you to reshare your slide so that you could take them to the slides where you have questions, so that they're in a better position to respond to the questions that you have raised and the clarities that you have sought. So kindly bear that in mind. And Moses and Emmanuel, if that is necessary, you'll alert us and he'll be able to reshare. So we'll move to Oluoch, who also has raised his hands. He probably has a question or comment. So Oluoch, please proceed to unmute yourself and ask your questions.
We were having a similar conversation in class the other day. So this talk could not have come at a right time, and I want to thank you so much for it. My comment is this. One of my takeaways is a comment by one of the speakers that, to paraphrase him, the factors that make a country or an economy grow are not just not increasing in Kenya, they are actually decreasing. In the midst of this, we have an emerging demographic that is demanding a lot from the government. And also amongst our biggest problems is the fact that these issues or these facts, the right people, the civil society, stands politics and the governance in the country, we talk about such things as corruption, but we do not necessarily realize the gravity of our crisis. Other than thanking you, I'd also like to invite you to our school in my class specifically, so that we can also talk more about this, so that perhaps the next policymakers can realize, because what I've picked is that we have a problem, and it is so grave that if we do not take urgent measures to address them now, our society might collapse, probably within this decade, God forbid. Thank you.
Thank you so much, Oluoj. I'm not too sure did you ask a question? Because we lost you at some point.
No. I just invited you to.
Yeah, you're just
my
giving
class.
us your comments and appreciating the fact that this adds to a conversation you're having in class, and it has given you a bit more insights towards that conversation, and a request for us to at least make an attempt to join those conversations at your school and have them with your class. Is that it?
Yes.
All right, thank you so much, Oluoj, for that clarity. So I'll go back to our presenters for this morning, Moses and Emmanuel. So we will go back to Majun's comments on your presentation, and then also the few questions, 2 questions he had on his slide. So if you need him to put back his slides, you would then proceed to make that request, but let's have you respond to Majun. In the meantime, if you still have any question, please feel free, raise your hand or type it in the chat box and we will get back to you. So Moses and Emmanuel.
Thank you. Let me respond to 1 or 2 questions that I think I picked up. One of them was from Winnie and one from Socrates. So about the global trade environment, and I think I heard a question about whether, what kind of trade opportunities that Kenya should be pursuing. Okay, as far as I could see, there is value in a stable market, first of all, domestically, and stability being defined in terms of a predictable tax regime, a tax regime whose tax rates are not very high, and that targets as broad number of households and firms as possible, not a narrow set. And then a tax regime that's also stable over time, right? So just it remains where it is. It doesn't fluctuate too much, and it doesn't rise especially. And then, that also has implications on, the size of our government. So policymakers, policy observers should be cognizant that the size of the government is actually places a weight on economic activity, and in a way that is unpredictable from the outset. But every time you raise taxes, you're destroying the economic structure of the country. So now, that being said, right, when you have stable conditions domestically, you can attract more investment from abroad. Now, looking outwards, open and free trade is a principle. Now, of course, principles, we find instances where they need to be bent for whatever reasons. One of them being that maybe a political consensus has it that certain sectors need to be protected. Well, that political consensus in whatever given sector should not go unexamined. But protectionism, we saw that our country's trade openness has actually been falling over time. So trade is becoming less and less a feature of Kenya's economic activities, whereas it should actually be more of a feature. But one cannot say that we can pursue open and free trade without inflicting some pain somewhere. But the fact of the matter is that it's it's there's no pathway that doesn't present some prospect of pain. So in closing, Kenya's rising per capita, even though it's slow, is also putting it in a position where it needs to look for new trade relations. Old uh, the sorts of carve outs that were being made for poor countries are not available for countries whose income is rising, right? So we're in a different position than, say, Tanzania, where African countries sometimes, I think there was a comment about the AU, but the truth is, I mean, the Nigeria and South Africa don't necessarily have the record of free traders, but then it's fashionable usually to point out, say, Kenya's pursuit of economic partnership agreement with the European Union, and to just immediately make a political assessment of that without asking ourselves what were the conditions underlying the pursuit of that agreement, and how might households and firms in that given country benefit, and could we have offered something better as, let's say, as South Africa or SADC as a bloc. So I think I would wade into those debates with some caution, just based on all that I've presented.
All right, so thank you so much, Emmanuel. Moses, do you have any comments or any response?
Yeah, just a quick one. And starting with what Winnie asked, what does this mean to our participation in the global trade landscape? Number one, this clearly shows us that, well, Kenya trade openness has been deteriorating, and therefore some of the consideration, as we have heard, going that we need to adapt some mechanism are not necessarily a good direction to head towards. And the reason why trade openness is being encouraged in this frontier is, if we open to trade, then it means we can actually focus in areas where cost production efficiency for Kenya is much higher, and then allow ourselves to trade with others from that point of view, that maybe we're not as efficient in this, and therefore it's more cost effective if we trade and import that from wherever, and then that gives us enough depth to do this. And if that is to be allowed to happen, and this should not be taken as the only factor that affects how we do our production, it's going to allow us to stop some of the subsidization of actually loss-making production activities that we are doing as a country. And then it also advises how we make our trade treaties. Like we can clearly see from the basket of commodities that we have a high agriculture-oriented basket. So what does that mean when we sit on a table to negotiate on trade? And as Dr. Majuni has clearly pointed out, the share of services in our international trade is almost at 50% now with the goods now. What does that imply? One of the things is, well, we need the service contribution growing, but we also need the goods level growing substantially high, so that we're not almost at a 50%, and that this does not mean we should shrink the service, but what are we not doing right that the goods and commodities trade is actually almost at the same level with our services? And this could be a question of, when we make our treaties, and like I pointed earlier, we have we have a problem as a country because the advantages we have are agriculture and labor intensive because we have labor, but the world is yet to embrace that. And that should advise how we actually deal with other countries when we are actually making these treaties. I think that's it, Winnie. Thank you.
Thank you. Thank you for responding and for your comments, for your added comments as well. I can see we have a few more hands raised. Of course, Dr. Majun probably has another response or a question or a comment, and I can see Anthony. So I'll start with Anthony. Anthony, please unmute yourself and ask or give your comment, and then we'll go to Dr. Majun.
Thank you. I don't know whether you can hear me.
Yes, we can.
Now, I'm also not in the field of economics, but I'm a keen student of economics. I'm in education. And I love this presentation. One thing I've picked is that since the days I was a student, we are still engaged in the same product when it comes to our exports. And we seem to be firmly grounded in agricultural produce, which don't fetch a lot in the international market. I'm wondering whether we are, first of all, intentional about that, or we're just going with the tide. If there is any specific plan we have to either diversify our export commodities or substantively add value to the items we export so that we can fetch more at the international market.
All right. Thank you. Thank you, Anthony. Are you
Thank
still there? Thank you. Dr. Majun?
Okay, once again, thank you very much for the comments, Moses and Emmanuel. So mine is just a quick one, and I would like to be optimistic. My thinking is now that the services are really growing and it's becoming factual that maybe that would be the way. It's not only happening in Kenya, but it's happening to several other countries which are almost in our state. How best then can we do what people call servicification? So for instance, if you are having comparative advantages in some of these agricultural commodities, how do you incorporate services into them so that you possibly sell better or produce, enhance your productivity? I think that's what a few other people have been trying to do. I did something like that from Kenya, and I found it something that is viable. And I don't know what would be your comment, but I think an aspect where we have the services complementing the goods rather than trying to have them go separate ways. Thank you.
Okay. Winnie, do you think, can I take those two questions? Yeah. Okay. So I think both questions have around, okay, there's servicification on the one hand, and a question about concern that Kenya's economy is highly based on agriculture and the inherent risks. What I'll say is this, okay, I think there's two ways that we can approach this, right? One way is to ask ourselves, what is government doing that it's in the way of entrepreneurs, right? Getting in the way of firms and households, and how can it just get out of the way in terms of focusing on producing, on delivering public goods and services, and ensuring that in its delivery of public goods and services, it is also not wasteful, in some responsible fiscal policy, right? So complexity Now, the reason that I presented the complexity question without really talking about services is twofold. First, I think the data set focused on goods, but secondly, because complexity is the thing that is common across both goods and services production. And I don't know that a government should have a target to let's say improve the question is it the job of the government to discover where the services sector should grow, or is it the job of the entrepreneur? Should the entrepreneur be let alone to make that discovery by themselves, right? And that's saying that since if the intensity of knowledge is an emergent property, right, which means that we're saying that we need to be doing more knowledge intensive activities. So then the question is, what can the government do to produce, to kind of engender the emergence of those knowledge intensive activities? Well, part of it is it has to just maintain an economic environment that is stable, because knowledge is like the emergence of knowledge should actually be compared to the emergence of spider webs, of cobwebs, like in your basement, right? Because your basement, or if you have a room that's really, really stable, it's not aired, it's dark, and no one barely goes there, then a spider will find it a very calm environment in which to spin its webs. And any interruption, and those spider webs are so fragile that they'll just break, right? And they'll disintegrate. So knowledge intensity is the same. If the environment is stable enough, then, over time, entrepreneurs would invest in, say, machinery and try to produce more and more manufactured products. Then the next question is, okay, can the government do something to give them kind of a boost? Well, we could start with the delivery of public goods, and let's just look at the big mistakes we made over the last years to compare with what we could have done, right? The standard gauge railway was an investment in a piece of infrastructure, was ill-informed, and now it's contributed to the kind of fiscal distress that Kenya is experiencing, which means that the Kenyan government has no room to do anything else. But in its place, what the Kenyan government could have done is invested in more, you could say, is it the kind of infrastructure that gives consumers and producers more choice in terms of engaging in their own activities. So if you had a highway from Mombasa to Kisumu to the border, so the importers and exporters, they're putting their goods on the road and they're moving them about, and maybe that would be about the same cost as your SGR, but probably carry more cargo, right? So right there, you're seeing a place where we missed an opportunity, but not only did we miss it, now we have to pay for the mistake that we made. But if you had that road, and then it's easy for goods to move into the country and across the border, well, an entrepreneur sits there and figures, look, I could engage in this specific activity. Now, the activities that he's discovered, it's important to note, it's the government, that entrepreneur is in a better place to discover those activities than the government is. And so I'll close that off by saying the difference between Kenya's service industry and Japan's service industry is that Japan's service industry benefits from that same level of knowledge intensity that other Japanese sectors benefit from. So that Kenya's, even if you drove investments into Kenya's services sector, you wouldn't approach what Japan has, because everything is interlinked. So say you want to open a design office for that designs motor vehicles here in Nairobi, and to design motor vehicles for Japan. Well, maybe you have to get on the ground and figure out what does that entrepreneur need in order to build that services firm that is producing a very high value service product, right? Doing high level industrial design rather than a low level service product like handling telephone calls. So the critical thing is that you can't plug and play whichever service that you want or whichever manufacturing activity that you want. It has to it has to be embedded within a knowledge space that can actually carry it and a production space that can carry it. But that's my comment. I invite a response. Thank you.
Moses, any response or any comments?
None. Thank you.
All right. I can see for, I think on Watch who wanted to see how they could connect with Emmanuel and Moses so that this conversation can be carried forward to their class. Watch, please notice on the chat box, Emmanuel has posted his email address. So kindly touch base with him and see how you could proceed with that conversation. And then Dr. Majuna has also posted a link to a read. So if you could all take time to have a look at it and link it back to this morning's conversation. That said, I'm not sure anybody else has a question or a comment before we close our meeting by allowing Emmanuel and Moses to give us their final remarks. Any questions or any other comments? Great. So Emmanuel and Moses, please take at most a minute to please give us your closing remarks on this morning's topic, and then we can close it and allow us to proceed. So I'll start on the reverse. Moses is ready with his closing remarks, so I'll go ahead and start with Moses. So Moses, Karibu.
All right. Just a statement or a line. We can clearly see that Kenya's international trade landscape needs a lot of spanners in the work. This in terms of policy, in terms of structural and economic activities, and also in the advocacy space of it. But clearly, as a country, we need to realize that our policy orientation, our monetary policy, the exchange rate, and how that affects us and builds up to what trade happens and what that means to consumers at the very end of the chain. And therefore, carefully, we need to use the evidence we have to advise our policy and avoid unnecessary political right answers to the questions of why is Kenyans and Kenyan economy not looking up, whereas our peers seem to have maybe figured a way out. Thank you very much.
Thank you, Moses. Emmanuel, your closing remarks?
Thank you. Thank you, everyone, for attending. My closing remarks are these. If countries like Kenya cannot afford the kind of policy gaps that have characterized our policy making now, with regards to trade, even though trade is international, it depends a lot on what happens here domestically. One question we'll have to answer is how can the public actually improve the chances that good policy enters the policy making stream? And that's one question we'll have to answer. But in closing, Kenya should be free to pursue the kinds of trade relations that are good for it, and that's as much in the spirit of African independence as anything else. But even as it pursues those trade relations, there will have to be consideration for the trajectory of its macroeconomic policy, the effect of its fiscal irresponsibility, the kind of how it just sucks the oxygen out of all that we want to do and all the aspirations we have as a nation, and the trajectory of the intensity of knowledge of the activities in which we are engaged an inescapable fact. Thank you so much.
Thank you so much, Emmanuel, and to our audience. As always, at the IEA, we are very grateful that you always make time to join our webinars, to join our conversations, and that you're also always very free to share your insights and give us your comments. Your comments to us are very important because those are what we use to improve ourselves and to improve the content that we give to you as our people. So a polite reminder, the IEA is still a membership organization. So if you are interested to join us as a member, please reach out to our communications team and they will be very glad to take you through the process of joining our membership, and we'll advise you on what package you fall under because we have different packages. Also, please continue being on the lookout on our websites because we still have more interesting conversations up ahead. So just be on the lookout on our website and on our social media pages, and you will get an alert on our next webinars. And if you have any area that you think as the Institute we should tap into, please feel free to write to us at admin@ieakenya.or.ke and share with us those areas, and we will be more than glad to see if they fit within the IEA goals, and we will be more than glad to proceed to have those conversations. That said, thank you to Emmanuel and Moses for the insights we have gained, and we wish all of you a lovely, lovely afternoon, and we hope to see you at our next webinar. So thank you so much, and you are free to exit the meeting. Asante.